So this is a special edition in some ways of the No Dumb Questions podcast, along with Doug Flynn. I'm Connell McShane, and we've come today to tell you to calm down, relax, calm down. There's nothing to see. Really put people at ease. So I don't know. You got to laugh. So the reason we actually are putting this podcast together is in many ways, in my view, Doug, the reason we started the podcast to begin with, right? The idea was that we have to give more attention to issues surrounding financial literacy in the country, right?
Exactly.
So what does that mean, and who does that apply to? And the way I kind of look at it is that it's a broad term that's not paid attention to enough so that people understand issues that are going to affect their money and their finances. And it applies to everyone at different stages of their life, not just to young people who feel like they don't get it, but to middle-aged people who are afraid to ask the questions, why we say dumb questions, or older people who haven't made the adjustments they need to make. And I think one of the mistakes that we make in the media world that I'm in, especially financial media, which I was in for many, many years, is that we do these broadcasts and shows on a day-to-day basis when the market is volatile, and we're in a volatile period right now, where we're catering in many ways to the short-term investor or to the professional investor and forgetting about the masses, because most people are using financial markets as a tool to invest for the long term, or I think an even better way to say it, save their money for something, big purchase, retirement, whatever it may be. And those people often get ignored. So that's kind of my setup, is to say, all right, we've been through periods like this before. We've gotten through them before. So how do we do it? So you're the expert. Let's start. And what should those people, the majority, I think, of the people that are in the country, what should they be thinking about in times like this? Where do you want to start?
Yeah, I think it begins with whether or not you want to have a trader mentality or an investor mentality. And a lot of times the short term can really focus us more on trades. Like, what should I be doing now? Should I be selling something now, versus thinking about the long term and what are the impacts? At the end of the day, the market is not a mysterious place. It's a bunch of companies that are trading on a stock exchange, but those companies, they're still selling stuff. Now, maybe they have to change the way they're doing it and source and whatnot, but they're still companies that if well run and adjust, will thrive in the long term. And that's what you have to focus on as an investor, is this money is your long-term money. And so if you get away from the trade that you might be making for 3 or 6 months and focus on investing for the long haul, 5, 10 years or longer, that kind of shifts your focus on what's going on right now. We've had a number of these larger corrections just in the last couple of years, but we always act like the most recent one is different, or it's bigger, or it's somehow something different than it was before. But, literally in 2022, which is not that long ago, the market did go down 25%. And it ended up down 19%. But we seem to all have forgotten that. And that was only 2.5 years ago that happened. So these things do occur. And granted, this might have been more self-inflicted than something sort of out of the ordinary. But there was a lot of talk of recession during that time. That's what that was about. And so some of that is resurrecting again. And so you use these points in time to refocus on the fact that over 10 or 20 years, yes, there'll be adjustments, but that's not going to matter if you buy good companies.
It's interesting to me because, as I mentioned, the business I'm in a few minutes ago, Neil Cavuto, who was always a mentor to me starting out for many years, used to always have a picture up in his office of the Dow Jones Industrial Average, like a 100-year chart of the Dow. And the point was, relax, everybody. It always goes up over time. I kid with Neil, that's because he was there covering the 1929 market crash. But he actually did cover, when he worked at PBS, the 1987 crash, and then was there at CNBC and later at Fox for all these other periods of time. And now we've been through a bunch of them ourselves, post 9/11, 08, certainly COVID, all these times in our respective careers where, we've come through it. Now you have, and have talked about the market working through cycles. And this is something I think people can keep in mind, and maybe a good place to almost start the longer term discussion now is like you have optimism, euphoria, fear, and surrender. I think the market term for that is capitulation. It should just use surrender, right? It just means throwing in the towel. Let's get out of this. I can't take it anymore. So what does that mean? Where are we now, and how should people think about it?
Well, we're clearly, of those four stages, we're clearly in the fear stage right now. The fear gauge index is very high. People are fearful. They apply things like, first it begins when fear begins with like, it's okay, I'm a long-term investor. And then it shifts to, wait, this time it's different. There's something different about it.
Yes.
And that fear escalates. And then at some point, they do throw in the towel.
I've done that in my mind, and all shows you why I do. That's why I really am a long-term investor. I don't get involved in, maybe I should more, but I don't get involved in movements because I find my mind, it's hard to do because my mind, especially covering it day to day, goes right to that fear a lot.
Yes.
I remember doing it in 08. Like, oh my God, this whole thing could actually fall apart. That Lehman Brothers weekend being like, all right, well, joke's a joke here, but what the hell? Merrill Lynch, all these, and then everybody said Goldman.
We were dangerously close to financial
Goldman
implosion.
Going to go, and now, and again, this time thinking, well, this is the first year of this guy's administration, Trump, and he does seem different than last time. So maybe this is different. So that's a really good point. Continue on that.
And I
this
think
time
that
is different.
It's different from what the reason is, but it isn't different from the standpoint of we go through these cycles, and the cause might be different. But at the end of the day, you're getting these companies which were very, very overvalued in a lot of measures to getting, right-sized in their valuation. And so, we focus in on a high point on our statement in valuation. And then when it goes down, we don't like that. But then what happens is at the point when just about the last person gives up, because there'll be a period of selling and people just can't take it anymore. When I always think the market, does the most damage to the most amount of people at any given point. When the last person sells, that's the point in time when it turns around. So, and when it turns around, that's when the optimism begins on the other side, and the cycle starts to turn around, because the optimism is things have gotten so inexpensive. They're good companies. Even, and as typically happens in a downturn, they tend to throw the baby out with the bathwater. If you have companies that have zero tariff impact and are going to continue to do what they do and nothing's changed, why are they down 25 or 30%? The fact is, they shouldn't be. And
shouldn't
so
be down that much. I mean, they might be, the argument might be that, if the economy is going into recession, it's going to be tough for a lot of people to make money. Right.
It could. But if you're talking about utilities and whatnot, are people going to use the lights less? I don't know. So at some point you hit way beyond, and then that's where the opportunity comes in, and that's where optimism begins, and people begin to start to trade. And so they start with, okay, I'll just invest a little. That's where it begins.
I always think about, what should we do? Like, what should the normal, this person that, this kind of fictional character that we've created in the situation, but which I don't think is very fictional, do? Because it's not, there are professional investors out there that have all kinds of reasons, by the way, and maybe we should spend a minute on that, where they have to make moves, right? Because, and that's what leads to some of these outsized market movements, because the firm they work with or another firm that they're associated with might have borrowed too much money and they need to unwind some of that, or they need to, all that kind of stuff plays into it. So that's a different animal. And then you get kind of short-term regular people, people that don't work maybe in finance professionally, but they're, they like to move around their money on a relatively short-term basis sometimes. But again, I think that overall, this is a minority of the kind of wider investor class of just people walking around that are in 401k plans or whatever the case may be. So this idea of what should I do? I mean, one of the things I know you've talked about is kind of like rebalancing. There's some sort of rethinking, but also sometimes it's just stand pat and do nothing. I guess it depends on your situation, but it's a hard thing emotionally to work through.
It is. The example was just in 2019, 5 years ago, the most common portfolio is for retirees and people that are saving retirement is 60% stocks and 40% bonds, the classic 60-40 portfolio, right? So if you had that portfolio 5 years ago, just because the stocks, even though they went up and down, but because they did overall well, the 60% stocks grew to 72% stocks. And that 40% bonds became 28% bonds. Now, what happens with most people is when things are going well, they don't really want to make any changes. The stocks are doing so well, so they let it ride. But what you should have been doing, and what you should do, is had you been rebalancing that back to 60 along the way, now when there's a downturn, instead of having 72% of your money in the market when it craters, you only have 60. So you suffer less, but your bonds, which now instead of only being 28 or 40, are probably up now to 45 or even more percent, maybe even 50. And so now what you should do is go back when the stocks are down, now let's say to 55% because you had them at 60. But what happens is that person that had 72, they might only be back around into the 60s. And so even though they should be adding, they don't feel like they want to.
You recommend that 60-40 for everyone or just certain age groups?
No.
So when do you switch to it usually?
Most of the time when you're in your 50s, that's a good allocation. So if you're younger, obviously you want to have more in stocks, assuming you're comfortable with the volatility. Maybe you have less money in your early years. And the older you get, you probably want to have it flipped. When you need income, you might only even want to have 40% stocks and 60% bonds because now you're shifting more towards an income focus. But 60-40, to 40, if you take all the people that are super aggressive when they're young or comfortable with it and older being more conservative, it kind of blends in and around there to that number, even though some people are there.
What about individual stocks? We're talking, I think, a lot now about people who are just balancing percentages of their portfolio. A lot of that is 401k or retirement plans, which are largely based in mutual fund investing. So you're owning this kind of basket of the market. What about people who do buy individual stocks or given stock at their company, whatever the case may be? The idea, Tesla is a good way, I think, to think about it just because it's in a lot of people's minds right now. It had a huge run up and, it goes back to your original point with the 60-40. You could have been making a ton of money on it. It's tough to want to take quote unquote profits or pay taxes on those profits or whatever the case may be. But what do you say about people's percentage of their portfolio in an individual stock?
So it's always look at the overall market and recognize that if you're going to be more than that, that you're taking a risk or a bet. And so as an example is if tech stocks were originally 20 to 25% of the market and had gotten to about 30 or 35% of the market, if your portfolio is 50 or 60% tech stocks, then you're living with that extra risk that can work for you or it can work against you. And it did work for you for a long period of time. But that's where the greed kind of kicks in. And so if you just know that, hey, relative to the market, and that number moves. So relative to the market, where am I? If the market's 30% tech stocks and I'm at 50, maybe I don't, with my next dollar, buy another tech stock. Maybe I diversify away from that. Or maybe I do trim something that has run itself up. It's hard to do that, but there's nothing wrong with taking profits and going to an area that is a little bit undervalued because that's what the market does. You're not going to get tech stocks to be 100% of the entire S&P 500. That is never going to happen. There are 10 other sectors. So you have to know that there is a finite end to it. And if you're already double that exposure, that's okay for as long as it works, but you should just know that. And a lot of people just didn't realize that between what they owned in their S&P, their growth stocks, that they were at these numbers. And so when it goes down, now you suffer much more greatly. And the opportunity now to buy when perhaps you should, you're not going to do. And had you kept it more in line, when things go down, now that's the opportunity to take something that has held up or gone up to buy into these. And that's what people can gain by the rebalancing. But it's just easy to let the winners run and not pick your spots and take some profits. We see it a lot. But those are the kinds of things you want to look to. And remember how you're feeling now. The next time we get to an all-time high and you look at your portfolio and say, maybe I'm going to book some of these gains that I have at that next all-time high, because we will get there again one day.
Just as hard as it is to get through this, it's hard to do that too. That's why this stuff can be difficult. We have to rely, you have to stay steady. You got to stay steady because then you're thinking, wow, it's only going to go up more. What about cash? What about cash allocation? So say we're going into a period, I don't even think it's that hypothetical, but just say we're going to a period now where, your monthly expenses are going to feel like they're going up, right? Because the price of some goods, if that's what tariffs leads to, goes up, and that you feel a little squeezed. So you don't want to stop investing, right, in the stock market, right? But do you want to have a little bit more cash? And if so, how do you recommend people allocate the amount of cash they have? What should they have in their bank account or their portfolio that's in cash?
Well, hopefully whatever they're putting in their 401k was above what they already had in their cash cushion. So if they had a cash cushion, then perhaps it does make sense to increase the amount of cash that you do have, because if things get more expensive, that's a cushion against that. If things have a tariff can have like a one-time pop effect, maybe it's not inflationary compounded, but nevertheless, there could be a jump on some things. And I think the whole game here is that maybe that's going to get offset with some tax cuts or lower energy costs or whatever else go on. So maybe it's not overall, but it's good to plan that maybe it is going to cost more and you should have a little extra cash on the side if you can. Now, if it means you have to cut back on your 401k investing, I would never turn it off because you're going to miss buying at these lows. But, you know, it can make sense if you don't have any cash to lower that a little bit, build up some of that cash for something like that before you raise it back up. Ideally, I don't want people to do that. But if they have to, just don't go to zero on your 401k because you're going to miss all of that and maybe a match. So you have to just be conscious of that. And
then I guess the final thing would be, it's interesting, and this is, again, we're recording this on a day when the market is quite, I use the term volatile because it's back and forth all over the place. And as a matter of fact, you know, right now at this point in time, you know, market's coming off, way off the lows, going up. We see this, and you know, whether in bear markets, right? If you're in a bear market, they call it a bear market rally. Some people call it a sucker's rally. So when you start to see the market, it's been down for days, right? And you're like, oh, okay, we're through it. And then that's another thing. Maybe you'd still have to stay the course, right, with the original plan, because then it could go up a ton, go back down. When we're in periods like this, it can be unsettling, and I feel like in both directions. So going back to your point, what if we don't see the surrender? Sometimes the surrender, that last point, I mean, you start optimism, euphoria, fear, and surrender. So sometimes the surrender is important, right? And
you have to get to that point where you just can't take it anymore. And I mean, we're only a couple of days in here, so it's not even really getting there. People are starting to get nervous. But yes, if it's prolonged and they just can't take it anymore and they do capitulate and sell, that's when the optimism
But that can be a good thing because that's when you get turned.
It turns,
and then pausing, and you know, there's we might not do a tariff here. All right, the market's up,
fits
and then
starts are not going to flush everybody out, which is kind of what you want in the cycle. Now, after optimism, by the way, we didn't talk about it, but you hit that euphoria point, and that's the point when we're screaming at all-time highs, and people at that point say, "Oh, it's a good time to invest," and they want to throw money in at the high. Which we're doing the opposite at that point as professional investors. We're saying, whoa, let's take some money off and wait and put it on the side for the next downturn. People are just coming in. Now it's the opposite. All that money we put in bonds.
Buy high and sell low. The old saying. Oh, wait.
And so, the opposite of what people should do. But here's something I found really interesting. If you look at the last 100 years and you look at every 1 year holding period in the market, about 3 out of 4 of them are positive and 1 out of 4 is negative. That's basically the numbers. So you have to deal with 1 and 4 being negative. If you stretch that out to 10-year holding periods, you look at every 10-year period for the last 100 years, 98% of them are positive. Okay, so only 2% of the time are they negative. And here's the kicker, especially with 401k and long-term money, and even money that you have in your portfolio that's going to be with you for the rest of your life, whatever the rest of your life is. There isn't a 20-year holding period in the market that is negative. There hasn't been one. Now, we could say maybe there'll be one, and maybe this time will be different.
But that depends on your outlook on life. Some people are half full, half, oh, well, it's never happened before. It's got to happen at some point, versus other people that say we're good to go, which I think we should be in that camp.
In the last 100 years, a couple of things have happened. You know, so I'm just saying a couple of wars and a whole bunch of stuff has happened in the last 100 years. And yet, there's still no 20-year period. So to your point of all of this comes down to money you need tomorrow or within the next 12 months should have never been in the market. And money that you don't need for 10 or 20 years, that's exactly where it should be. And somewhere in the middle is some kind of a mix. And even your long-term money, depending on your age and your need for income, doesn't need to be 100% stocks. And all of your liquid money doesn't need to be all cash and bonds, but the majority of it should be. And if you just mind those time frames, then these are the times when opportunities present themselves, and you can take advantage of it versus being whipsawed by the feelings of this market cycle that happen. And that's the benefit of thinking long term and separating. I'm a big fan of separating your short-term money from your long-term money versus just having it all in one type of account and using it for everything. If you do that, you look at your long-term money, you're like, okay, it's down. Your short-term money's probably up because it was cash and bonds. And you're like, okay. And that's how you need to focus on it.
I think we should start marketing this podcast as like a healthcare podcast. I feel like, like make America healthy again, Kennedy. I feel mentally the blood pressure's coming down. I feel more relaxed. Thank you, Doug. So I think, Gotta stay calm, carry on, whatever you want to say. So I feel like, I hope that instead of what we do too often, like I said at the beginning, on TV and radio and podcasts and everything else all the time, and go tick by tick and oh my goodness, and
Mhm.
what's his latest tweet? Oh, we're off to the races. Oh, we're gonna, it's Armageddon. That we calmed down a little bit and said, hey, we've been here before. It's looked a little different, but we've been here before, and we got through it, and we'll get through this. So
Exactly.
thank you, Doug. I feel better,
Yes.
right?
Happy to
And
be here.
we'll see you guys next time. And any questions, hit us up on social media. Remember, no dumb questions, right? For Doug Flynn, I'm Connell McShane. Thanks for listening and watching, and we'll see you on the next episode.